It was taken up with a lot of community support by FASB. After a very thoughtful process, they came to the conclusion unanimously that they should give Bitcoin fair value accounting treatment rather than indefinite intangible accounting treatment. The latest communication on that indicated that they'll make this mandatory for all public reporting companies as of December 15th of next year.
In a recent interview Michael Saylor had with Nick Baccia, the crypto expert explained what it looked like for operating companies that will take on Bitcoin as a cash metric and journey so far for companies who had already started buying. He gave his reasons for his notion on the advantage of Bitcoin over sovereign debt for companies in the world of corporate finance. He also made a mention of the toxic treatment given to Bitcoin over the years due to its different and non-conventional nature and before the implementation of the new policy. The new policy, he believed, seemed inevitable as many mainstream companies were already taking up the responsibility of owning and acquiring Bitcoins. So the issue had to be taken up with a lot of community support, and a unanimous decision was made for Bitcoin to be given a fair value accounting treatment instead of an indefinite tangible accounting treatment. The implementation of the new policy, as he stated, will soon be made mandatory for all public reporting companies, and it will later on be made optional for companies to decide whether they want to adopt Bitcoin or not as their cash metric. Laying a good emphasis on the significance of the latest development in the world of the crypto system in which Bitcoin can be held on a balance sheet, he likened accounting for Bitcoin to accounting for the portfolio on your balance sheet. We will now bring you clips from the interview. But before then, please click the like button, subscribe to our channel, and turn on the post notifications so you get notified anytime we upload an informative video like this. Thank you.
The significance of fair value accounting coming to Bitcoin is it makes the asset non-toxic for an operating company to hold or a company that uses GAAP accounting. It also makes it transparent, the performance of Bitcoin-backed companies to be transparent. And so that's a positive feedback loop, right? When Bitcoin companies are performing well, it'll be obvious to Wall Street and they'll want to finance more of them, right? So that's a secondary benefit. And the third is because Bitcoin is a commodity, it's a financial commodity, it can be held on the balance sheet of an operating company where right now only treasury assets or sovereign debt type assets can be held on that balance sheet. As a treasury strategy. Now, if you think about your treasury strategy, the treasury strategy of an operating company is we want something which is liquid and fungible and low risk. So traditionally, the most liquid, fungible, low risk financial asset is just the dollar, the local currency, maybe the euro, maybe the dollar. And so that's the obvious thing to do. I collected $100 million this month. I put it in the bank. Now, the problem with that is that the dollar doesn't generate a yield. And the dollar is a depreciating, debasing financial asset. So in a world where the dollar gets inflated 7% a year, if the money supply of U.S. currency increases 7% a year, and it has over the past 100 years, then $1 billion in cash is going to cost you $70 million a year in purchasing power. And of course, at 7% a year, over the course of 10 years, you'll cut your asset value in half. So it doesn't take a rocket scientist to figure out that a treasury strategy based just on currency isn't awesome. It's dilutive. The question here is, what's the next best thing? Well, the next best thing is sovereign debt. Sovereign debt is debt issued by a government. So you've got the most creditworthy counterparty, maybe the United States government. You don't really think they're going to default. And that's the advantage of sovereign debt. You might take on duration risk. If you buy long-term bonds when the interest rates are low and interest rates go up, then the bond will trade down and you could get wiped out that way. That happened to a bunch of banks about a year ago. Silicon Valley Bank and the like, they bought long-dated credit instruments and interest rates jumped from 0 to 500 basis points.
A week before the interview, the executive chairman of MicroStrategy, Michael Saylor, had posted an update on X, formerly known as Twitter, informing the public and crypto enthusiasts, likewise of the decision of the Financial Accounting Standard Board's FASB, to permit companies that hold cryptocurrencies on their balance sheet use fair value accounting principles when importing their crypto asset holdings. He expressed his enthusiasm in the interview and highlighted the importance of the fair value account as it makes assets non-toxic for an operating company to hold. He also said it is significant because it makes the performance of Bitcoin transparent, piquing the interest of Wall Street and thus financing companies. Furthermore, he added that since Bitcoin is a financial commodity, it could be held on the balance sheet of an operating company only where treasury assets or sovereign debt assets are stored as a treasury. Since operating companies are allowed by regulators to hold as much property as they can compared to securities, Saylor is of the opinion that the companies will go for Bitcoin instead of other properties like sovereign debt and the dollar. The latter being a traditional property which, however, does not generate yield, making it a debasing financial asset.
The problem with commodities is there's a dysfunctional, systemic, endemic inflation built into the system. Not only is it possible for someone to create more oil, it is a certain thing that when the price of oil triples, they will create a lot more oil, and no one is concerned about keeping the supply of oil in check over the long term. There's this dysfunctional competition. You can try to create a cartel like OPEC, but people that aren't in the OPEC, like the frackers in Texas, they're not in OPEC, and they're going to frack oil, and they're going to bust that cartel. And all of these commodities find their cartels broken, and the gold miners want to produce more gold, the silver people want to produce more silver, soybeans want to produce more soybeans. So commodities aren't scarce. And I want to distinguish between that kind of ungoverned inflation or dysfunctional inflation versus the governed inflation of equities. You know, Apple Computer or any company in the S&P 500 can also issue more stock. And if you buy infinite amounts of the S&P index, you'll get a lot more stocks. They will issue more stocks. During the height of the market boom in 2021, when you had GameStop and you had all the meme stocks, you saw all these people printing a lot of equity and selling it to the market. And that's the danger of those assets. But at the end of the day, Tim Cook doesn't want to print infinite Apple stock. I mean, Tim Cook understands, and his board of directors understand, that if they want to maintain the credibility of the corporation, they have to maintain some control over the amount of shares they issue. And the same is true at Microsoft, and the same is true at Google. They may print more equity, but it won't be ungoverned and dysfunctional. But imagine there were 100 companies called Apple, and they could all print Apple stock. And people want Apple stock. So maybe Tim Cook wouldn't, but the Apple competitor number 4 in Timbuktu, they could, and they could sell Apple stock. Well, in that case, they're all going to print as much as they can to drive the price down because they're ungoverned. And in fact, they have an incentive to sell the stock. And so that's what it's like in the commodities business. Somebody somewhere has an incentive to drive the price of that commodity down, and they will sell as much as they can get their hands on. And so that being the case, there's never been a commodity like Bitcoin that was scarce. The closest thing to something like Bitcoin would be acreage in Palm Beach, or acreage in Miami Beach. Not the square footage, but rather the underlying dirt. Because there's only so many linear feet of beachfront property in Palm Beach for the last 100 years. And no amount of money printing, and no amount of capital, and no amount of technology, and no amount of manufacturing know-how creates more beachfront property in Palm Beach. So when you look at that scarce, desirable property that you can't create more of, you can see that actually does go up in value. That's gone up by a factor of 1,000 in the last 100 years, 1,000x. And that appreciates at the rate that the money expands. But the problem is, It's not a treasury asset. I can't buy and sell square feet of Palm Beach every day in the market. I can't liquidate it on demand. So the kind of property that I would want to hold, I can't hold as the CFO of a publicly traded company. The kind of stuff I can hold, sovereign debt, it isn't scarce, and it's a currency derivative. And so Bitcoin is this new thing. It is a digital scarcity that's liquid, that's fungible, that gets commodity treatment, that I can hold on a balance sheet as a treasury asset. And while the currency is not generating a yield and the bonds aren't trading up in asset value and they're generating taxable yield and with a negative real yield, Bitcoin will appreciate in price tax deferred.
In his interview with Nick Baccia, Saylor emphasized the uniqueness of Bitcoin as a commodity, given that every other commodity in existence is characterized by a dysfunctional inflation built into the system, whether governed or not. Making a succinct distinction between the governed and ungoverned inflation, he still pointed out their similarity of causing havoc to price of the commodity. Bitcoin is different because it is decentralized, hence the price cannot be monopolized by an individual. It is a unique commodity that can be bought, sold, and liquidated at any given time. He went on to compare the cryptocurrency to a carriage in a Palm Beach. The latter, in this case, is a scarce, desirable property that you can't create more of, no matter the amount of manufacturing, know-how, printing, technology, or capital. More can you liquidate the asset on demand, which makes Bitcoin has edge over every other alternatives in corporate business. Unlike the carriage, Bitcoin is a treasury asset. He described Bitcoin as a digital scarcity that is liquid and fungible and still gets commodity treatment. What are your thoughts on Michael Saylor's views on Bitcoin in relation to corporate finance? Do you agree with him on the positive change that would come with the policy change by the Financial Accounting Standard Board? Please drop your comments and your opinions in the comments section below. Also, don't forget to like this video, subscribe to our channel, and turn on the notifications bell. Thanks for watching.